Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Oil prices are falling even further, actually. Brent crude and West Texas Intermediate, the two key benchmarks that we're taking a look at, are down more than 50% or so from their peak in 2022. Our next guest says in a market hyper-focused on headwinds, particularly tariffs, it's worth acknowledging that cheaper oil is like a sneaky little tax cut. What do lower oil prices signal about the markets, and which sector benefits most from this dynamic? Joining us here today to unpack her latest market thesis, including the sectors that are on her radar due to the oil price and other things, is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Welcome, Denise. Happy Thursday. How are you?
Hi, happy Thursday. I am very well, even in the rain.
Okay, you got some rain. I think we sent it to you, perhaps. We've been sitting with it for a few days as well. So let's go through what you talked about to us a few months back when we didn't actually know what Liberation Day tariffs were going to be. We then found out what they were going to be. And you were sort of looking at if the tariffs come in around 15% up to a range of, then this should be what happens. Of course, they were more. And so that kind of changed things up. But in fact, the math that you gave us months ago is sort of starting to look like what we're dealing with right now, around that lower percent of tariffs this world.
It is starting to look more likely. And I think that the math behind tariffs is a little complicated in that we all know that tariffs act like a tax through higher prices. We just don't exactly know who they hit and in what proportion. So some of it could be absorbed by exchange rates, some of it could be absorbed by the foreign producer, some gets absorbed through the US consumer, maybe some in US corporate profits. But we can start to make some guesses and say, okay, well, maybe at 15% tariffs, which is looking now a little bit more likely than the 30% reciprocal tariffs, how much of a hit could that be to the US consumer? Is this a recessionary tipping point or not? And I think that the math you can come to is, roughly 15% on $3.2 trillion of imports. Let's just call it, $500 billion of tariff revenue on a run rate basis. I'm adding in some sectoral tariffs that haven't been announced yet. But if we say that that's all shared between the US consumer and the US producer or US corporate profits, none of it is absorbed anywhere else. That would be about a $250 billion hit to the US consumer in terms of higher prices or in terms of that decline in terms of marginal propensity to consume. So that's only a 1% headwind to consumption as a percentage of income. And what's interesting, when you look statistically through history, we've seen those 1% hits before in 1968, 1993, and 1982 via tax increases. And none of them have ever been recessionary. And I think we're starting to feel out the reason why something so onerous as a 1% shock to income isn't the tipping point, is because more often than not, you can have an offset. So oil prices are that offset this time.
Amazing.
And we might not get the tariff math right, but that 100 basis point headwind that I just talked about from tariffs is the exact math of the yearly decline in energy prices as a tailwind. So energy goods and services are 3%. They're down 30% over the last year. That's roughly, let's call it 100 basis point tailwind that might be offsetting the tax increases to tariffs. Again, this is back to, we don't know the real math and we don't know in terms of what's going to be right or not. But I think that the math just illustrates how important oil prices are to stocks, the economy, and the US consumer overall.
So the US consumer and the economy, let's go there first. So oil prices being down just puts a little bit of a spring in most people's step, because it just means their costs are coming down in every proper way. And the budget that they thought they were going to have to crimp on because tariffs were going to take out this much has just got a cushion, essentially. It's the economy that takes that in. What does that then translate to in terms of sectors? I mean, I suppose all kinds of sectors could benefit, in fact, if you just have cheaper costs for consumers.
That's exactly right. I mean, the filtration in through the stock market and sectors individually is via margins and earnings growth. So you do see, despite the fact that energy goods and services are now only 3% of income versus in the 70s and 80s, it was more like 7, almost 8% of income. So it's less shock worthy, but downside shocks are still beneficial for the US consumer. And you can see it in linear math, even over the last decade. The lower oil prices go, the more likely stocks are to be higher. Why? Because the more likely earnings growth is to be higher. And when you dig into what sectors that benefits, one of the reasons why I like evaluating sectors is because it's a clean divide towards those. You can either skew very defensive, those defensive sectors like consumer staples, utilities, healthcare, or telecommunication services, that old sector, or more economically sensitive like consumer discretionary, financials, technology, et cetera. And this shows a very clear skew. Once that consumer receives that, let's call it a tax cut, because you have very inelastic consumption of oil prices, whatever you don't spend usually goes right back into your budget. So that is very positive for consumption growth and earnings growth. And as much as it's good for the consumer, and you would think consumer discretionary stocks would be the most closely related to
That's what I was thinking, yeah.
Good guess. And they are. They are. There is a linear relationship, and the lower oil prices are, the more likely consumer discretionary stocks are to outperform. But the significance and the magnitude and the correlation is stronger in technology.
Okay, so this is fascinating that the economic, because we think of technology as the thing that we would spend on anyway. It must be within the stocks themselves. Go to the technology sector, if you would, for a little bit. I mean, we've been watching a very concentrated market turn into a market with a bit more breadth. We've been watching hyperscalers in terms of their market cap pull back significantly. The story of tech, if you would, just while we kind of put these two pieces together.
Yeah, I think it is. For some investors might be a little bit of a bridge too far. I don't understand how lower oil prices impact technology, which is basically the productivity push in society that's not correlated to interest rates or other things, because it's so idiosyncratic growth based on the intrinsic pricing power of the products they develop. But yet you see this massively linear correlation, even over the last decade, of the lower energy prices are, the more likely technology stocks are to outperform. And also, the more likely earnings growth is to accelerate in that sector. Again, there's a linear relationship. Some of it is just the cyclicality of that, leverage to higher GDP growth. And some of it is the actual impact on margins, meaning that lower oil prices are an input cost to a lot of companies. And it's correlated to a lot of other input costs that are important to technology companies. And all of that filters through into margin expansion, which is already fairly elevated. So maybe we talked about before where, given the valuation disconnect that we've seen in technology, finally coming out of those top 2 quintiles of relative valuation, all the way back down to median levels, what you find is there's a risk reward in terms of outperformance. You don't need to get margins right, because the expectation is, given the hit from tariffs, they're probably too high in terms of earnings estimates, and margins are likely going to come down. But some of that is already discounted. And to the extent that you get input costs to fall, maybe margins don't have to come down as much as you thought. So maybe you get both a valuation expansion and an earnings expansion as we look through the course of the next 12 to 18 months.
Okay, so what you're describing right now is even X, all of the announcements that we heard yesterday. I mean, there were eye-watering tech deals done in the Middle East by the Trump administration yesterday. We also had more swirling news about a deal with Iran, which in theory could open up, I think, 4 million barrels per day of oil released onto the international markets. If it were to happen, it's all big ifs right now. But I mean, those were pieces of the story yesterday to oil and whether it would drop further, and also to massive tech deals, which will filter their way back in, we assume, to the US economy. So X all of that stuff, the history that you gave us is that oil prices are connected to tech doing well. When oil prices drop, tech does well. Nothing to do with yesterday.
Nothing to do with yesterday. No, it's not indicative on that at all. And some of it could be a corollary, and I actually have to look at the data. But I think that when you think about all of the things we struggle with as investors, like, are oil prices going to stay low? So will it continue to be beneficial for technology? Or are these deals all going to come through? All of the things that we struggle with about knowing the future, I think sometimes valuation offsets the bulk of it, meaning the starting point on valuation, when you're as low as 50th percentile or 60th percentile for technology stocks that do consistently grow cycle to cycle, you tend to have an advantageous starting point. So sometimes you can ignore all of the headlines and just focus on what's already priced in. And I think in some ways, for me, that's what makes technology so attractive right now. You're even seeing this, I know we've talked a lot about software, you're finally starting to see this valuation in semiconductors, even including NVIDIA. When you package them all together and you look at the relative forward PE over the last, let's call it 10, 20, 30 years, and you rank it relative to its history, now we're finally in the bottom half of the distribution. All of a sudden, the risk reward changes, really regardless of what those deals look like, sometimes what energy prices look like, and valuation just bakes in a set of news that might not be as negative as you think, creating much more of a tailwind to what has been a leadership sector over the past 5 years, for maybe another 5 years.
So interesting. So, talk a little bit, if you would, about some of the data that we received. You were mentioning, just when we spoke earlier, PPI coming in, the discussions of hard data coming in to reflect, is it recessionary? Is it not recessionary? Is it disinflationary? Is it not? What are you seeing? Because it seems to be actually quite difficult to read data. There's a lot in there, pull forwards. There are all kinds of seasonally adjusted pieces. I guess we have to make peace with that on some level because it's predicted to be like that for a little while. But what are you watching on that front?
It is going to be complicated in terms of the pull forwards we saw with imports and just the seasonality that I think that even the government is struggling to grapple with residual seasonality. But I think that as much as we are concerned about tariffs increasing prices, I've been more in the deflationary camp over any 1 year period than an inflationary camp, which is not to say that the math of inflation might not be higher over the next 2 or 3 months. But I think that as much as we struggle with these models that tell us if tariffs are this, then the impact on prices will be Y. I think that delta that we're all calculating, like I said, a 1% hit, is it a 50 basis point hit, it's a 1.5% hit. What we really should be struggling with is what is our underlying run rate of inflation as we're getting it now, pre-tariffs. And I think that the recent CPI that we just got and the PPI this morning, you put them together and you say, okay, well, maybe the tariffs aren't in there yet, but what was our underlying run rate and what was the trend associated with that run rate? And PPI, or input costs, were actually down for the first time on a core basis, and I think the better part of 5 to 7 years. So that was a big downshift. So, even higher goods prices were more than offset with lower services prices, and the underlying run rate of the CPI, we saw the exact same trend. So core CPI now ex shelter, which I always quote, yes. Right? Shelter isn't going to be impacted by tariffs, right. And shelter is going to have these long lags with housing prices that is still catching up. Core CPI ex shelter, 1.77% year on year. This is important in terms of your run rate. So if you say that prices are going to increase by, let's just say 75 basis points, well, that's a whole lot different if instead of 2.8, you're really talking about 2.4. So all of a sudden, the trends and the underlying run rate of inflation is much lower than maybe investors were expecting, which might mean that as much of an impact as tariffs might have, it might have not as much of an overall impact as you think.
Because pre-tariffs, even pre-November election, the trend, as you were saying, was disinflationary. That it was coming down. People were getting ready. The Fed did do its cuts. And we were thinking perhaps there would be more if this continued. So underlying all the noise of tariffs, you see this trend currently intact.
Yes, the disinflationary trend, even with tariffs right now in the beginning stages of tariffs, is still intact. We'll see how it evolves. It took some time in 2018, and our experience with washing machines was a great example. It did take 2 or 3 months for those price impacts to actually filter through. So we will still see some filter through, but to the extent that trend in disinflation persists, and there's no reason why it shouldn't persist in the underlying things that aren't tariffed, what you will likely find, especially on the service side, is that might be a bigger offset than you thought which means that tariffs might not have as big of an impact on inflation as you thought, which means that maybe the Fed can cut for good reasons more than you thought, which might actually bolster the market more than you thought.
Do you think, this is a little bit of a side question, but we used to say there are a bunch of ways that government can get out of debt. So you can grow your way out of debt. The inflation story can come in to nibble away at it. There are a few different ways. When you watch some of those deals being crafted yesterday and announced and so on, does it take your mind anywhere to, gosh, maybe you can grow your way out of debt? I mean, just in fact, that will come back to the U.S. economy and actually lift things in an old-fashioned way, and maybe the tariffs will be needed a little bit less on balance. Maybe I'm just being Canadian optimistic, hoping that's the case, but I'm just curious if your mind goes there when you see like massive deals being crafted.
I'll join your optimism. I mean, that my mind doesn't necessarily go there, but I will say that what we've seen in terms of, I always thought it was funny that we coined, the last year, American exceptionalism. We're really talking about 3% real GDP growth. When you look at the long history of GDP growth in the United States, that's nothing. I mean, we used to grow 4.5% to 5% quarter on quarter in the late 90s. That's real growth. We have not seen that yet. To the extent that you do get some sort of impetus, maybe a pro-growth tax packages, maybe better bilateral trade agreements that offer deals to actually grow more production in the United States, to the extent that you get that with that disinflationary trend, that does have the ability to provide something very different than what the CBO and what other government organizations are assuming in terms of growth and inflation over the next 10 years, which is how we sort of assess debt and deficits. Oh. So there is that underlying issue where of course, you can grow your way out of debt. That math actually can work to the extent that inflation is, quelled and potentially on the lower side. But that also could not just come from bilateral trade deals. That can also come from productivity benefits from technology companies. Right. So there's two ways that it can actually be achieved.
So as a couple of questions. Let's go to these first. This has to do with the deflationary story or disinflation. Thoughts on the strong labor market and lower inflation despite tariffs. So it fits there. If you go to the labor side of things.
Yeah. So the labor side of things, I don't particularly think it's strong.
That's interesting. I was just going to say it's kind of strong, but okay, why?
It's okay. Again, So remember, I look at historical data. So it's stronger than people think, and people talk about, oh, it's so strong. I think you're looking at the unemployment rate, which I think doesn't really port to anything. So people point to that as a tight labor market, which is going to create wage pressure because there's no supply, right? So that's the function of supply and demand. But that's never been true historically. And we're actually living it out that it's not true. In fact, what we've seen is a low unemployment rate. Wages have decelerated massively from, I think that the peak in average hourly earnings was 6.5, and now I think we're down to 3.5. So if that were really a good barometer of supply and demand and of the narrowness of the labor market, then we should see wage prices increasing. So I think that it underestimates supply when you look at that. Looking at non-farm payrolls, the growth in non-farm payrolls it's fine. It is certainly not bad. We're not contracting, but we're back to that sort of American exceptionalism, interesting data point. We're also not growing either. So unemployment is rising modestly, but labor is actually growing modestly. All of these are sort of modest, meaning that we have supply on the sidelines. Labor costs are actually decelerating. We got unit labor costs, which are a really good negative correlation to profit margins, and they're at some of the lowest levels in history. So our labor market is okay in the sense that it is growing and potentially could be accelerating, but it's also not restrictive enough to restrict the Fed, meaning that wages aren't accelerating with it. So it sort of shows you this big statistical flag that I think there's more supply than you think. And we still see that, where the labor force is actually growing faster than many investors expect, despite what we've seen on the immigration front.
That is fascinating because that is not sort of in that case, how close is the Fed needing to switch to its other mandate? This seems to be the question.
Right. That's right.
Do you do you see that as, well, it's a place to watch, but is there
Yes,
anything
it is
there?
definitely a place to watch. I
Okay.
mean, I err on the side of, look, I think that we had an overshoot of a lot of economic indicators in terms of unemployment being too low sustainably. So the rise that we've seen in the unemployment rate, remember, we were all concerned about the
Yes.
SOM rule. I think some of that is just a reversion to normal. So it would not
Okay.
be surprising to me to still see a rise in the unemployment rate revert to normal, even without concern for the labor markets overall, meaning that the Fed has to cut. So it always comes back to the why is very important of why the Fed is cutting, right? It's never the whether or not the Fed is cutting.
Right.
If the Fed is cutting because employment is a real problem and the unemployment rate is rising rapidly, that's never a good thing for the market. To the extent that the Federal Reserve can cut, because yeah, maybe unemployment's up a little, but inflation's still down or lower than they thought it would be as they entered the year, so they can decrease real rates as we go through the year. I think that that's the positive risk reward that you're looking for investors, and that's the positive risk reward for the economy as well.
Okay, fascinating. Let's go back to oil and where it fits with sort of the fiscal story, in a sense, as a stimulus story ultimately for the economy, and where that sort of filters through to the tech story. So just take us back to, I guess, the idea of a net stimulus when you sort of pull back and see what oil has done for consumers in the economy, for companies in the economy. Are we in a position where overall it's stimulative or not yet?
Yeah, I mean, we'll see. So the way this year is evolving, remember, we were worried about 30% tariffs. That's, let's call it $1 trillion in tariff revenue. That would be potentially, worst case scenario, I shouldn't say worst, maybe there's always worst case scenarios, but $500 billion hit to the consumer. That's 2% of income, right? That's a recessionary hit. To the extent that you settle on 15, again, we're all guessing, but let's put some numbers to it because I think it's important, because recessions come via shocks. And that's the math of a shock, right? This is what we want to struggle with. Okay, so let's say it comes in more like 15. That's, again, a $250 billion hit to the consumer, 1% headwind. A lot of that has already been offset by oil. We'll see what happens from here, but 250 negates 250. And oh, by the way, there's a tax bill coming. Again, we don't know the real numbers, but it could be anywhere from 150 to 300 billion we're talking about in terms of retroactive tax stimulus for the consumer. So as we entered this year, we didn't know oil prices. We were concerned about tariffs. Could that be a $500 billion drag? And now it might be, again, staying open-minded to all the facts, that we exit the year saying, well, tariffs only turned out to be $250 billion. We got $250 billion from oil prices, and we got an extra $100 billion from tax cuts. Instead of being a net drag of $500 billion, we were actually a net add in terms of stimulus of $100 billion. So that's the math that you could do on the shocks that are tariffs. And that's, again, why we always have to stay open-minded of the other aspects that are continually moving.
Oh my gosh, you're so smart. We're so lucky to talk to you about this because it really does flip a lot of different things potentially on their head, but they're things to keep an eye on. Oil is its own story within the commodity sector. Gold is too, but there's a lot in between. We've got soft commodities, we've got other types of metals and mining and so on. Does what we see for oil, does it act for a stimulus even in those parts of the economy? Do you look to some of those sectors as well right now?
There are some corollaries. They're not nearly as strong as the impact of oil prices or of lower oil prices. But you do see, as much as oil does beat to its own drum, it's got its own supply-demand dynamics. Obviously, it's got its own OPEC. But there is a correlation between those commodity prices, especially the harder commodities like copper, that you see with oil prices. So it might very well be that there is more commodity pressure in the pipeline because of lower oil prices.
That's really interesting on the supply side of things. Like they might need to kick it up. Okay, really interesting. And let's just kind of close out. There is another question on sectors. So let's go into your top three, bottom three, and then I'm going to ask you something about interest rates to close out. But let's go to the top three.
Yeah, great. Top three. So the three that I put in the top are all, I think that they're the same three that I keep talking about. So I just gravitate between them in terms of what is best risk reward. I think if you asked me 2 months ago, it would have been financials. It is definitely now technology now as the best risk reward that I see in the market. So in rank order, number one would be technology. Software is the sweet spot within it, but I'm warming up to semiconductors. Hardware is the least attractive for me, but you can own the whole index. Behind that would be financials. As much as I do still like banks, all banks, big diversified banks, small regional banks, I do think that more brokers and capital markets are the more interesting sub-industries to look at, given the decline in the market. And then the third would be consumer discretionary, which I will say that home builders don't still have a negative risk reward to me. I think the supply and dynamics specifically for new homes is not there, but the rest of consumer discretionary still looks like an attractive place. So that's my top three. The bottom three would be utilities, number 1, 2, and 3, really. Behind them would be consumer staples, and then I think healthcare as well. So it would be the defensive sector. So it's very clearly an economically sensitive skew towards offense versus defense. And I think energy still skews negative in my work, but I'm much more negative on utilities and staples than I am on energy, given the run that they've recently had.
And the healthcare piece and where it's positioned within your ranking, nothing to do with recent drug pricing announcements. That was before.
No.
That was before. Okay. There's a question rolling in here about inflation. Can you share your expectations for interest rates based on what you've been saying for the short term and a bit longer term as well?
It's a good question. I don't usually give spot estimates on things that I don't think are really predictive to the market, because as much as everybody wants to know about interest rates, I do think that they're a sideshow, a statistical
right now
sideshow.
Or always?
Most of the time, but certainly right now. So they matter a lot when they're very high and rising, or rising very rapidly, which I don't think that we're going to be in a situation over the next year and a half, or when they're falling and falling very rapidly, right? Those two scenarios are usually very high and rising inflation. You got to be above 4.5% and rising, or we're going into a recession. Those are your two times that interest rates are predictive as it relates to investors in the equity market. I think that we're just going to be in this muddy middle. Look, I don't want interest rates to go up too high, but I also don't want them to fall too rapidly, which that would be sort of coincident with a decline in growth. So I think that the 10-year didn't go up a lot when the Fed raised interest rates, right? Because the curve was inverted. So I don't expect it to go down a lot while inflation decelerates. The short end of the curve is a little different. I would expect much more softness at the short end of the curve when the Fed can actually cut, because again, my base case is that there'll be less inflation than the Fed thinks, and the Fed will be able to move rates a little bit more accommodative for that reason. So I don't really have a strong, stick in the ground or stake in terms of where interest rates will be. It wouldn't surprise me if on the 10-year side, they're around where they are right now over the next year. But it would surprise me if 2-year yields are where they are over the next year. I think that they're likely to be lower.
Okay, fascinating. And what do you think that we should just kind of keep in mind going forward? I mean, it's mostly to cut through the headline noise and risk, I would say. What should we keep in mind from what you've been telling us, and also how you're looking out to the future a bit here?
Yeah, I think because the market was down so much, always gravitate towards the struggle of what the market has already discounted, as opposed to evaluating headlines. And I know the market's bounced back a lot, but the fact that it was down 20% discounted a 15% earnings growth contraction. Remember, earnings are growing right now by 10 to 12%. To the extent that numbers get cut and that earnings growth goes to zero, it is still better than the 15% decline that the market was discounting. Wow. So you end up in this odd situation where the market does in fact climb the wall of worry. You get the bad news, but it was already discounted at the low, and it's marginally better than where you are. So as much as you want to stay abreast of the news and talk about the news, I think that we always have to gravitate back to what did the market discount at the bottom.
Fascinating. We are so grateful for your time. Have a great weekend ahead. We're going off on a long weekend over the next couple of days, but we wish you well. We'll see you soon.
Enjoy it.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.